John Lanchester, How to Speak Money, What the Money People Say, and What It Really Means. Delve into the world of finance with the summary of How to Speak Money, What the Money People Say, and What It Really Means by John Lanchester. With its jargon-busting and instructional approach, this summary equips you with the tools to understand key economic terms and concepts. From neoliberalism to the efficient market theory, securitization, derivatives, credit default swaps, hot money, shadow banks, bitcoins, and quantitative easing, you'll learn about the essentials of the financial system. Get ready to become a savvy participant in discussions about the economy and make better informed financial and democratic decisions.
The language of money. Language is a crucial tool in all aspects of life, including the fields of economics, business, and finance. Experts in these fields often use jargon and specialized terms to communicate more efficiently, but these words can also exclude outsiders from understanding. Certain terminologies can even entrench a particular worldview, ultimately affecting society's organization. However, while the language of money can be complex and daunting, it is essential to learn to make informed democratic decisions and manage finances better. Proficiency with this language excludes those who don't understand it, but it's possible to learn through related experiences and expert guidance. Although most vocabulary in the world of money is value-neutral, the terminology can lead people astray in some areas. Economists who share unrealistic assumptions could potentially have dangerous, out-of-touch perceptions of how markets and societies should function. Despite this, the conversation regarding economics remains ongoing, and it is still crucial to understand the language to join in and form one's own opinion. The impact of neoliberal philosophy and efficient market theory. Neoliberal political philosophy has revolutionized the organization of societies and economies to benefit individuals. This has led to policies that affect income inequality, free trade, privatization of government services, deregulation, public spending, and the belief that markets can self-regulate. The efficient market theory dominated policymakers' mindset before the 2008 financial crisis, assuming that market prices correctly incorporate all available information. The theory explains the investment strategy of arbitrage, where traders profit from tiny price differentials before prices equalize. However, it downplays the possibility of bubbles or speculative manias. The success of momentum trading contradicts this belief, showing that price movements carry forward from one day to the next. The complexities of securitization and derivatives in the financial crisis. The 2008 financial crisis was characterized by the widespread use of securitization and derivatives, which transformed traditional mortgage debt into complex financial instruments. While securitization allowed for quick trading and profits, it reduced incentives for safe lending and made it harder to assess risk during the crisis. The use of derivatives in securitized assets further complicated the situation, as the volume of derivatives exceeded that of underlying assets. Credit default swaps and hot money also contributed to the risky environment, leading to a credit crunch and massive deleveraging. This summary highlights the role of these financial innovations in the crisis and their connection to neoliberalism and efficient market theory. Rethinking bank regulations. Large banks operate at surprisingly low equity ratios, which is an issue of debate in the financial industry. Shareholders of big banks have limited liability, prompting calls for different ownership structures to make them further liable for downside risks. The 2008 financial crisis brought up questions about the role big banks played in the financial system and their leverage practices. Regulators measure a bank's leverage by calculating their loans that exceed the value of their capital, converting the result to an equity ratio. Major global banks maintain slim margins of safety by running at low equity ratios. In the early 2000s, many banks operated below the industry standard of 3% mandated by Basel III. Some banks prefer using a core capital measure, which adds some types of profits and debt on the equity side in an attempt to appear safer. However, this measure is a matter of debate within the financial industry. Shareholders of large banks have limited liability and can only lose the value of their shares. Consequently, advocates call for different ownership structures for risk-taking investment banks to make owners further liable for downside risks. The 2008 crisis exposed the moral hazard problem in the financial industry, where shareholders and employees reaped limitless rewards from the upside but risked limited loss. The government's bailout in the 2008 crisis only put the cost at the taxpayer's door. Therefore, rethinking bank regulations and ownership structures is necessary to prevent future crises. The complex world of finance. Shadow banking, bitcoins, QE, and interest rates are critical topics in finance. Shadow banking is a growing sector outside the traditional system of regulated depository institutions. The industry significantly contributed to the credit crunch and has become a subject of concern in ongoing financial policy discussions. Bitcoin is a digital currency created by computer algorithms used mainly for anonymous online transactions, but the arbitrary acts of trust underpinning its value make it fluctuate wildly. Quantitative easing, QE, was introduced as a way to stimulate economic activity when interest rates could not be lowered further, but it comes with the risk of inflation when the government buys back bonds with money it creates out of thin air. Interest rates are critical to forming opinions about government policies and personal finances, as they are a measure of risk-free investment return, affecting mortgage defaults, amounts of home equity, business investment, manufacturing costs, and industry outsourcing.
Now that you've learned essential financial terms and concepts in the summary of How to Speak Money, you're better equipped to participate in discussions about our global financial system. Recognize the connection between neoliberalism, efficient market theory, and their impact on events like the 2008 financial crisis. Understand how securitization, derivatives, and credit default swaps created complexity and risk in the financial sector. Acknowledge the growing presence of shadow banks and cryptocurrencies like Bitcoin, as well as policies like quantitative easing in response to financial crises. With this newfound knowledge, you can make more informed choices and engage in conversations around economics, finance, and global markets.